Let's bring in Sarat Sethi, managing partner and portfolio manager at DCLA. He's also a CNBC contributor. Sarat, welcome. One question for you. This is like the third time I've read a similar intro today about people expecting a higher for longer Fed. Does that give you any pause here that maybe things are going to play out differently than what the current consensus it clearly is?
You know, I think when you look at the data coming in, you look at where the economy is, and, you know, yes, we have to have leading indicators saying things are softer, but you also have the positives that, you know, the economy is still strong, and the Fed sees that. They're going to keep rates higher. They're going to keep them higher for longer, and that really, if you're doing what we do, which is investing capital, you have to kind of marry that with what earnings are going to be as well. So I think that calculus is changing in the sense that, look, we're not going to get this drop off in interest rates that, you know, people were expecting at the beginning of the year. So valuations have to then actually adjust to that. And I think that's where investors really have to focus.
People, Sarat, always like to know where kind of specifically you're looking to. As Stephanie Link said yesterday, it's a year for stock picking, she thinks. I mean, with all of these cross currents, market timing is going to be really difficult. So how do you get to a Delta, to American Express, and for what time horizon do you feel comfortable with exposure to those names?
So I'm looking at valuation too, and I think that's going to be really important. You want companies that are reasonably valued, that, you know, both of these, American Express and Delta, trade below what the market is trading at. And you look at earnings expectations of what is management saying. So Amex, even on their last call, confirmed what they're going to be growing double digits. They are in the sweet spot of the premium card business. Gen Y and Z users are using their cards more and more. And as we've seen, people have moved from goods to services, right? So they're traveling, they're spending more on entertainment. And the interesting part on both, and actually goes to Amex and Delta, if you look at it, the leisure traveler has really picked up. They didn't really have that pre-COVID. That was really being carried by the business traveler. So if that happens in addition to the leisure travel, prices are still going up. Amex makes money as prices are up. Don't forget, they make their percentage based on charges. Trades at 16 times earnings. So if you look at kind of where they're going, it's really is in the sweet spot for the next 2 to 3 years.
Why?
No, please.
Why shouldn't, Sarat, people just go own a 5% 6-month T-bill instead?
Because I think if you look out 2 to 3 years, you're going to get a better return. So take a stock like Amex trading at 16 times. If it grows 10 to 12% a year with a 2% dividend yield, you're going to get a double-digit return as opposed to 5%, which you're absolutely right, you can get for 6 months. But what happens? Let's look at where the yield curve is. Let's look at 2 years out. Maybe rates go back to 2 to 3%. At that point, what do you do with your capital? Because the stocks will have already reflected at that point. When rates go down, the valuations go up. Delta is 7 times earnings and free cash flow positive, the best run airline out there. You know, they're trading at 7 times earnings. And again, if they grow their earnings 10%, you're going to get, even without any multiple expansion, a price, you know, uptick. So that's kind of where we're looking at. Now, there's no question that based on any individual allocation, should you have bonds, it's actually a better time to buy bonds than we had for many years, for the last probably 5 years. So there is another alternative, but if you're going to be exposed to equities and that's part of your allocation, that's part of your risk profile, you really want to pick stocks that are cheaper than the market, that have better outlooks than the market, and that actually can do better than what we think by just holding cash.